All right, so we are back. Welcome, happy Juneteenth. So as usual, just quick market update. Market was closed today. Fed yesterday was kind of a nothing burger. You know, Powell came out and left rates unchanged, which we knew was going to happen. Futures are selling off now. Not exactly sure what that's about. A lot of times the day after Fed Day is the active day when people have, some time to sleep on it. I do think what they kind of came out with might have been a little bit hawkish. I think you had like 9 out of 19 governors were saying 1 to 0 rate cuts this year, which is certainly hawkish. I think there was some stagflation talk. Also rumors about, entering the war in Iran. So yeah, and if again, I'll say it. I mean, if that's what we're selling off about, then I'm a buyer tomorrow.
It's selling off because of Trump. Trump said that he's going to make a decision if he's going to bomb Iran in the next 2 weeks.
Yeah.
So that's really the big news today. That's the reason why the sell off in the futures.
Yeah, I mean, I hear that. He's been, that's been kicking around for a while though. I don't know. If the Fed wasn't yesterday, I'd say definitely that's it. But, a lot of time, I mean, it doesn't really matter. I mean, the market's down, 1%.
So what's the bad news? The bad news is he does bomb Iran, and then that's going to drive stocks down, or is that supposed to drive the stocks up? I don't get it. I'm not clear.
The way that stuff always works is initially the market goes down and then then it rallies.
Right, but I mean, look at all the stocks that are good, like AI and all this rare earth stuff, or name it. And all these things look like they would benefit from a war. No?
Well, yeah, I mean, a lot of stuff would benefit from a war, including gold.
Yep.
Which I'm sure we're going to talk about.
Right.
And then the speculation on oil is always going to pop.
Right. The key here is Iran exports 90% of their oil from one place.
Yep.
And all it will take is one bomb to take it out. One bomb, and you got oil doubling in price with one bomb. And so if it escalates, if Trump does bomb them and it escalates, at a certain point, Israel could just say, screw it, and blow that place up. And if Israel gets angry enough, I know that Israel probably wants to, but America, the U.S. is saying, don't you dare take that out, because if you do that, you're going to throw us into a recession. We don't want a recession. You do that, and you're not going to have any money because we're going to be broke. But at a certain point, Israel might get angry enough and do it.
You can't have
This is
low, though.
This is Don Durrett, Gold Stock Data, by the way. So let me ask you a question, Don. So you think that oil prices can double if a certain
one bomb?
Yep.
But I don't think it's going to happen, because if Israel took out that platform, it would take them 6 months to rebuild that. So you're talking all that oil would come off. I don't know if it would double. It would definitely go over 100.
Right.
But I don't think Israel will do it, because the U.S. is basically, we're funding them, and we're saying, don't you dare take that out, because if you take that out, it's going to cause, who knows what kind of damage that's going to cause to our economy and the global economy. And so I think we've pretty much told them, don't you dare do it. But if the war does escalate and things get really hairy, that's definitely something that Israel would love to do, because that's their revenue. So you're literally taking away all their revenue. If you're going to damage the country, that's the one thing you probably want to do. But
I mean, the aim is for a regime change. Most of the people in Iran are decent people, but the regime that runs it is like one of the last, big supporter of general, terrorist factions, if you want to just outright say it. So, I mean, the whole thing of trying to take out that regime and cut its funding is one thing, but I think it can already be done without having to take out the oil infrastructure. But
So Matt, is there like an oil VIX or anything like that? Is there such a thing?
There is. I don't know that it's tradable. I don't know the symbol for it. And I don't know that it's like easily tradable. I think there may be like futures
All right.
or something like that.
So, Don, let me ask you a question. We started on this show. Like we had a guest on earlier this week was saying that you have to pretty much take advantage of these volatility spikes in a day, week, hour, whatever, 3 days. So, do you think this could be like, again, I'm just asking you your opinion. Do you think there would be a volatility spike in oil where it would go up to 100 in a day or a week or a month? Or you're saying like over a course of time, because this thing is taken out, it would gradually get there?
I think it's all noise. Bring the S&P back up.
Yep.
The only chart that matters is the S&P 500.
Okay.
What your listeners need to realize and what investors need to realize is that the US is reaching a point of no return here with their debt situation. This is Triffin's dilemma unfolding before our eyes. The question is that how close are we to the end? And what I mean by the end is that the US has been living off of debt. And this started in 1971 too, when we were a mercantilistic economy from 45 to 70, 72, where we had a strong economy, basically. And then that started ending in the 1970s. And then we had the two oil crisis, early 70s, late 70s. And then everything changed in the 1980s. In the 1980s, we all became Keynesian, and we started using debt to maintain and grow our standard of living. And we've been doing that for 40 years. Right. And that is all coming to a head now. And that's why this chart's the only chart that matters, because this is the US economy. And I firmly believe that we have reached the end, and then Trump is the trigger. Trump is not the savior. He's actually the trigger for change, and not a good way. My opinion is that the U.S. cannot basically survive Triffin's dilemma.
What's that?
We cannot survive it. And what Triffin's dilemma is that what Triffin said, Triffin was an economist in the 1960s, and he wrote a paper and he basically said that the US is screwed because you decided to use the reserve currency, but you don't realize that by having the US having that currency globally, that undermines your economy. And the way that it undermines your economy is that it forces your currency to be stronger than other currencies. And so you can no longer compete globally. And then Reagan tried to use globalism. He tried to use globalism. He was spitting in Triffin's face and saying, we can do this, no problem. And he was putting gasoline on the fire for the Triffin's dilemma because he tried to implement globalism. And so we've tried to use globalism. Well, look what's happened. The middle class has been hollowed out. It's gotten to the point now where our middle class is dying before our eyes. That's what Triffin said, is that he's basically said, you're going to hollow out your manufacturing sector because your currency is going to be too strong. And eventually what's going to happen is what's happening today is that the dollar is going to get to a point where we can't export enough debt. So we've gotten into this loop where the rest of the world needs our dollars and we're exporting this debt, and now nobody wants it because we're creating inflation. And so we've reached kind of the end game here. And so I think what's coming next is we're basically topping out here in the stock market. We're topping out. Maybe we go to 6,500. I don't know, but we're topping out. I think we probably already did top out. Wall Street seems to think that we're going higher here. Everything's bullish. They're already looking for next year, thinking everything's fine. And I'm saying my call is no. Not only is things not fine, but all of this debt that's been built up, this leverage in the system, is basically we cannot handle a recession. So Triffin's dilemma is playing out, and so the next recession, which I think Trump is going to basically pop that bubble, that everything bubble, is that the next move down in the stock market, I think is going to be 30%. Whoa. 30% is where we're going down here in the stock market. And when we go down 30%, that's the end. It's over. And gold is going to be the big beneficiary here. Now, my thesis has been in play for 20 years. I've been waiting for this for 20 years to play out. This is not a new thesis of mine.
Right.
This is Triffin's dilemma just taking its time, but Triffin's dilemma was always inevitable. It's the von Mises bubble. Von Mises said, if you create an economic stimulus using debt, that's a bubble, and you either pay that off or that bubble pops. And if you take von Mises, and he's an Austrian economist, and I think the Austrian economist is much more sane than the Keynesians. The Keynesians are insane. Basically, they think that you can just use debt to generate wealth, and von Mises says no, there's no free lunch. And so I actually, if you combine the two, if you combine von Mises and Triffin, you basically recognize that the end is very, very close.
All right, which one do you guys want this one?
Oh boy. I got a little bit about that. I mean, if you kind of combine both, yeah, you can leverage debt to generate wealth and income, but at some point you got to stop kicking the can down the road. So that's what it's sounding like, is the can is just about to hit the curb here.
Right. And so the key here is the bond market. So I always said the reason why I got into gold and gold miners is because the US bond market would eventually fail. Now, that's been going on for 20 years.
Yeah.
Now, most people have always said that the bond market will never fail in the US, that we can print our way out of things. And that's kind of what MMT, modern monetary theory, says, is that if you can print your own currency, you will never default. But that has a problem. It has a fallacy. And the fallacy is that if you don't have any buyers of your auctions, then the buyer of last resort is the Fed. But when the Fed buys the debt, they print the money. And if they print the money, it creates inflation. And if you create inflation, that's the Achilles heel of MMT, because inflation destroys an economy. And so you have to have some buyers in those auctions. Well, guess what? We're at $2 trillion deficits now. That's $166 billion a month. And Janet Yellen was borrowing at the short end. And so what happens when you borrow at the short end is you have to keep rolling over that debt. And so this year, the US Treasury has to borrow $9 trillion, $2 trillion for the deficit, $7 trillion for rollover debt. And it's going to be a never-ending story because they keep borrowing at the short end. So they have to keep every year. We're not just borrowing $2 trillion. We're not just borrowing 1.5, 2.5. We're borrowing $5 trillion plus every year for the rest of the decade. Who is going to buy the debt? And if nobody shows up, it becomes a negative feedback loop very quickly. And what I mean by negative feedback loop is that once investors recognize that the only buyer is the Fed, then they're going to recognize that that's creating inflation and the dollar's going down in value. I don't want dollars. I don't want bonds. I'm selling my dollars. I'm selling my bonds. That's the negative feedback loop. That's what's on the precipice here.
Now,
Some people figured it out. Some people haven't.
are you in the camp that we're going to end up defaulting on our debt, or just?
I just said that.
Yeah,
more or less,
okay.
because it's got to come to a head at some point in that theory.
But I don't think it will be 100% default.
Right.
And I don't think it will happen overnight. I think it's going to take at least 2 years, because why would they default immediately? Right? The Fed and the Treasury are going to try to do everything they can to keep it alive, right? And so this will be a slow bleed. It'll be a slow bleed. And this is what gold is telling us. That's the reason why gold has been such a monster, because gold has already figured it out, that
Right.
this is the inevitable outcome. And the US Treasury is the foundation of the global economy. It's the foundation. And it's basically, it's no longer risk-free. And gold has figured out that it's no longer risk-free. And we're seeing it at the long end already, where a lot of people aren't touching the long end on the bond. It's already starting. That's the fragility that's already starting. That fragility is going to go all the way down to the 2-year.
Yeesh.
And once it gets there, it's basically a negative feedback loop that you can't stop once it starts. And this is like I said, this is von Mises and Triffin all playing out before our eyes.
Right.
And there's
So
no stop.
how is a default moved forward from? I mean, who buys what with what to accommodate that? That's
So what's going to happen is they're going to have some type of reset. I don't think it's going to happen until 27 or 28. They're going to have some type of reset where they default on a portion of the debt. And it's going to be nasty. It's going to be instantly inflationary because they're going to have to devalue the dollar when they do it. But I think what they're going to do is they're going to orphan offshore dollars. So right now we have the euro dollar problem where foreigners can create dollars. They can create money, and we don't like that. And so that's what the reserve currency allowed them to do. So what we're going to do, I believe, is we're going to orphan all those offshore dollars, and we're going to create a new dollar. And we create a new dollar, we're going to devalue it. And we create the new dollar, we're going to say that outstanding debt, we're only going to pay, say, 70 cents on the dollar for. So they'll devalue the dollar by like 30%. But what that allows us to do, it creates instant inflation, by the way, but it allows us to compete globally. So now we can compete a little bit because our dollar got devalued. So now we can sell stuff to the rest of the world, especially like our oil and natural gas.
so it's like
And so-
finding a bottom and then being able to climb
Matt,
back up.
Let me ask Matt a question here, right? Because I know this is the type of thing you think about, right? So Don here has an outcome, right? It's clearly, I think tail risk comes into play here, right? Do you think this is an outcome that has a 50% percentage, 80% percentage, 20% percentage? I mean, you must be thinking in your mind, this is an outcome that can happen. But I know you're probably like, this seems a little far-fetched.
No. So, but I don't look at it that way because, you have no idea. I mean, Jeremy and I are traders. So, the saying that I love is trade based on what you see,
Right.
not based on what you think.
Right.
So when and if this outcome actually happens, we'll trade it. So I own gold miners because I think, oh my God, we're going to default on our debt and, gold is going to go up. I own gold miners because they're a great thing to own right now. And that's why I own them. Now, certainly in the back of my mind is, all the stuff Don is saying. And I think I mean, I'm not going to put a number on it. I think there's a very good chance that a lot or all of that happens. I mean, I'm a math guy and, you look at these deficits and, you look at all of it and, and you see the big, beautiful bill and you realize these guys are never going to stop spending.
Yep.
Right.
You see what they did to Doge, where, for the first time ever, we had, the opportunity to go in and, at least cut the waste. And who knows? I mean, maybe the waste is, a rounding error, or maybe it's massive. My guess is the waste is massive. I think government is massively inefficient. And chances are they could go in there with a sledgehammer and cut out most of it and solve this problem, but they're not going to, for a lot of reasons that we don't need to get into. But, and Jeremy can speak for himself, but I mean, we're going to trade what we see. So I'm
Right.
not like, if I believe that we're going to go down 30%, which we are going to go down at some point, and it could be more than that. I mean, 2008 was 60%. I'll react to that when I see it versus saying, hey, I'm going to go massively short.
Right.
And, and like Don said, I mean, we could go to, 6,500 on the S&P. Being short for that entire ride would be extremely painful. You see like the Michael Burrys of the world who did that. I mean, they saw 2008 coming. They positioned early. They went through massive amounts of pain, and then they became billionaires.
Right.
I would rather have in the back of my mind, this could happen. I'm going to still trade what I see, and I see a market that wants to go higher. But when I see a market that wants to go lower, I will pivot and short the heck out of it.
Got it.
And again, I'm in gold, I'm in gold miners, I'm in silver, I'm in all that stuff. And as long as it keeps going up, I'll continue to be in it.
Got it.
And I love to layer in probability. I mean, it's for me, I ignore a lot of noisy charts and I look for the easy ones. I look for the ones that have the highest probability of follow through. So it can be very short-sighted and long-sighted at the same time. But then when you lay in economic issues like we're about to have, it always kind of weighs on you, and it always has its own layer of probability. So sometimes you can't quite trust the home run charts, and you got to be prepared. So that's what mitigating risk is all about. And Matthew and I have different ways to do it, but all in all, it works the same. So now we just got to say, well, if we see this 30% haircut coming, and we start to build into more of a certainty and less of a probability, what we do about it is more important than being able to foresee it. So
Got it. Okay, that's a good answer.
When we're layered in,
it also goes back to what we teach about hedges, that you
Right.
always have hedges because you don't know. I think that war is bullish, but again, Don brought up a good point. Let's say Israel bombs the oil. Let's say Iran closes the Straits of Hormuz. Let's say oil doubles. Well, then I'm wrong. Oil, war is not bullish, but you know what? I have hedges.
Yep.
And I have hedges in such a way, I hedge, a lot of what I do is hedging using the VIX. The cool thing about the VIX is, a small bit of VIX turns into a massive bit of VIX if there's a lot of fear.
Yep.
All right.
So let's move on, Don. So you're targeting what, like a price on gold here? We're at 3,100-ish now. Are you saying 5,000, 10,000, 100,000 next month, next week, next year? What are your thoughts on something like that?
Yeah, I've had to keep increasing my gold target because last year in February and March and April of last year, gold basically just took off.
Yeah.
It's been just ripping, right? I mean, just look at that. February, we were that's this year. I mean, if you go back to 24, can you take that all the way back to the beginning of 24? I mean, that's just this year.
Right.
Look at that. Look at February in 24. We're at $2,000.
Right.
I mean, we went up from 2,000 to 3,300. So I've had to keep increasing them. So I had my gold target when it was down there at 2,000 at 3,500. That was my target.
Right.
I had to move it up to 4,000, then 4,500, and now I've moved it to 5,000. So my target now is 5,000 gold. I think $4,000 gold is easy. I think $4,500 is a very highly likely outcome here on this bull market, and that 5,000 is something that we should expect. Silver, I haven't changed. Silver, you've been using $100 silver for a decade.
Yep.
And I have not increased it. Although my target has increased. On my website, I use 5,000 gold to value gold miners and $100 silver. And that's a 50-to-1 GSR, which I think is very conservative. But if you use a 40-to-1 GSR, it takes silver to 125. And I think 40 is where we're going, 40 or below, because we hit 39 in 2011. So I think my target for silver has increased to a range of 125 to 150. So if you get $5,000 gold, which is my expectation in the next 36 months, then you get a 33 GSR, which will be a pretty aggressive number. You get 150 silver. So my range is 125 to 150.
So you say GSR, meaning gold silver ratio for the latest form, yeah?
Yeah.
Like myself. I just figured it out though, actually.
So if you value,
that's good.
yeah, if you value gold miners at $5,000 gold, Newmont has a share price target of $300.
Yep.
Which is amazing. That's the kind of leverage you have in gold, and the silver miners have even more leverage. You use Hecla at $100 silver, and you have an 8 or 9 bagger. If you go to 125 silver, which is where I think I'm going to be, all the silver producers are over 10 baggers, which is stunning, absolutely stunning leverage in the silver miners. if we hit these numbers.
Can I ask you a question, Don? I'm not to be devil's advocate, but I'm just going to be anyway, right? So if you could, I could pull any number out of thin air. I mean, I could say, oh, gold's going to 1 million. I mean, it's like guys talking about Bitcoin, like Michael Saylor. Bitcoin's going to 37 trillion. I mean, I could say anything I want. So like, how do you back that up and not sound like you're just pulling stuff out of thin air?
Yeah, so what I do is I use probabilities based on history, macro, and the charts.
My kind of guy.
So if we combine those three on gold, so bring the gold chart up and go, I don't know, 24, go to 20 from 2020, beginning of 24 until now, you will see that we've been in, actually, you have to go all the way back. You got to go further because the bull market, there we go. The bull market actually started in December of 19. So I really like to have 2018 on there forward. You can see the breakout in December. There it is. December 19, you can see where it was flat. 25, 16, yep. 17, and 18, you can see where it's flat. And then, so we basically broke out right there. So that's when the bull market began. So bull markets in gold usually last 10 years. Normally, so 1971 to 1980, basically 9-10 years. And then 2001 till 2011. So this one started in 2019, in my opinion. So we're looking at a bull market that should go until 28, 29. And if that's the case, and we are in a bull market, there's no reason why this thing should not go higher. Just in the chart alone, normally when you get a bull market that goes 10 years, I mean, if we just look at history, if we look at the last two, 1971 to 1980, the big rip was at the end, right? We're at the beginning here. Right. We're at the beginning, not the end. So if you're saying, Don, your $5,000 target is too high, historically, no, it's not. In fact, most analysts have gold much higher than 5,000 based on technicals. Based on technicals, most of them have it $7,000, $8,000, $10,000. So my $5,000 target is actually very conservative from a technical standpoint. Now let's bring in history. Historically,
Jeremy's getting excited over there. I can tell, by the way.
I already know what the chart looks like.
Historically, we've never experienced a situation like this. I mean, you have to go back to Rome, really, where you had one country that was basically global, dominant country that experienced trouble because of foreign influence, foreign wars, and they went bankrupt. That country, Rome, they basically fell, right? And historically, that's kind of where U.S. is. U.S. is very, I mean, if you compare Rome to the U.S. today, it's very similar. You have our internal political system is devolving. We have these foreign wars that are bankrupting us. The correlation is amazing, right? So historically, we can say the American era is ending, which is very good for gold, right? You got that going now. Now let's look at macro. Macro is actually the strongest. Everything I just told you is strong, right?
Right.
Macro is actually the strongest reason for gold to go higher. That's the reason why you should own gold today. I mean, if you look at analysts that think, I said a 30% correction, I'm not by myself. I have lots of other people that are with me on this.
You are definitely not by yourself.
No,
I'm not by myself on this. Okay, you got Ed Dowd, who's
Isn't this Ray Dalio saying the same stuff too, right?
Exactly. Ed Dowd, he's I think he does amazing work, right? You got Jeffrey Gunlock, who's basically saying a recession's coming, right? You got Jeremy Grantham, who says this is the most overvalued stock market of all ever in his lifetime. That includes Japan. That includes the 1990s in the US. He says this is the most, right? You got Jim Rogers, who basically says never in his lifetime has he seen something that's happening today, right?
Right.
You got Stephanie Pomboy, who says the stock market is basically living on air. The U.S. economy is on air here, right? You got an overvalued stock market that's more overvalued than the 1990s. So the macro is actually more potent. You have
I'm pretty sure Kramer's bearish on gold
cost,
too.
you got the
Yep.
cost of living. The cost of living index is
That's the
decimated.
best indicator. Yeah, that's
The-
the
the
best
co-
indicator we got.
Right. So the cost of living index has decimated the US consumer.
Yep.
The only people that's holding this stuff up is the top 20% who have a bunch of money to spend. But the bottom 50% are hurting. They can't even pay their bills. And that's not going to get rectified anytime soon. You have small businesses that are basically having a hard time because you don't have that strong consumer. You have a housing bubble right now that is ready to roll over.
Right.
So I'm glad you asked me this question, because if you look at all three of the factors that I
I'm
gave you,
jumping off I live in a cliff. I'm about to go jump off the cliff
if you
right now.
if
I'll be
you,
right back.
if you look at all three of those
It's like,
factors,
we're done, guys. We're done.
all right, if you look at all three of those factors and you think that $5,000 gold is too high a target, then you're not looking at the same data I'm looking at.
All right. So let's say we buy in, right? We're down. So let's just move on to stocks. So, there's the GDX, which is a gold miner. Oh, go ahead, man.
We get into stocks. So,
Yeah.
so how would you recommend, the average person own gold? Should they
Right.
buy bars? Should they buy the GLD ETF? Or should they buy gold mining stocks?
Well, they definitely should start with physical, because that is your piggy bank. And whatever you like, buy a little bit of physical gold and silver if you can afford gold. Gold's a little bit pricey. If you can't afford gold, then you should just buy a little bit. You start stacking physical bars of silver every month, and once you stack a few bars, you should get a real energized on the fact that you hold these bars and you go, I want more of them. And I always say you should start with a minimum of 1,000 ounces. So that's $35,000, 40,000. It's a chunk of money.
Yeah.
But that's really where you should start, because if you have 1,000 ounces of physical silver, that's your piggy bank. And if silver goes to $100, it's $100,000. And $100,000, that can get you through a few years. So that's your piggy bank. So I think that's where you start.
Where do you tell people to keep that, man? Serious question. Like, where would you store that?
You have to decide. You have to do your own research and what's comfortable.
Right. Safe deposit boxes. Basement,
Yeah.
whatever.
Yeah,
go buy a safe.
Lots of different. It's your personal preference, really. But I would say this: there's no reason to be buying paper. You could buy paper physical if you don't want to hold it, but there's no reason to hold paper gold. Nobody should be buying GLD unless they're filthy rich and they're buying 1,000 ounces of gold and they don't want to store it. But everybody else, it's
Right.
100,000 ounces holds in your one hand. There's
Right.
not to take possession of physical gold, but taking possession of 1,000 ounces of silver, some people don't like that. So they can possibly do the ETFs, but I wouldn't do ETFs for physical gold. But ideally, you want to hold it. But that's a starting point. Then once you have your physical and you want to own miners, you have to decide how much leverage you want in the system. I have something called the H.E.A.T for gold miners, and then I have something called the Mormons for the silver. So my H.E.A.T for the gold, so if you're rich and you want to stay rich, there's no reason to buy high leverage gold miners. You just buy the elite. So you buy Newmont, you buy Barrick, you buy Agnico, you buy Alamos, you buy Lundin, you buy Kinross, Evolution Mining, Northern Star. Those are the H.E.A.T. And so if you're rich, you should have $100,000 of each of those and just collect the dividends. They all pay dividends.
Right.
And I mean, if I was filthy rich, I'd own those 8 stocks.
Can I stop you for a second? So Matt, you look at this chart, right? You would not be a buyer in here, right? I mean, this seems really,
Well,
you'd be a seller here now.
I own Newmont,
Oh,
but
yeah.
I own it here. So my trading style is counter trend. To me, the perfect buy spot was, recent buy spot was right in here when it had an undercut and rally at these moving averages. Now, if I were adding to it, I'd wait for it to pull back into one of these areas, but I own Newmont already.
So I'm the expert on when to buy and how to buy stocks, right? So take this chart back to, I don't know, 2020. And I basically told everybody when to buy the stock. So we actually had two.
Right there.
Right. So we had, yeah, but you could buy
Well,
like,
anyone could do that, by the way, just so you know.
so, but after the run, so if you didn't buy it back there at $25, so that was really, after that run you had 2016, which very few people were buying that. And then you had that period, but the recent opportunity was we had October of 23. So if we look at October of 23, it was pretty low.
Yeah.
Yeah. And then you had February right there, February of 24. And this is where I call the bottom. When it traded below $30, I said, buy this stock to the bottom. This is and it never went lower. But I tweeted out when I basically said, once it traded below $30, I'm like, this is your opportunity. I use a strategy called buy to the bottom. But the only time you want to buy to the bottom is when you see the bottom. And when this thing traded sub 30, I'm like, I can see the bottom. I said, buy this stock to the bottom. So those were your two opportunities. So in October of 23, the HUI went to 200. Newmont didn't go all the way down. And then in February, went to 200 again, but this time Newmont did go down. And so February of 24, anybody that was around that was buying mining stocks that didn't buy Newmont, anywhere from $30 to $35, they weren't really a Newmont buyer. They weren't really a Newmont investor, if you will. But anybody that was
you said the HUI went to 200. I didn't catch that.
HUI, yeah. So bring up the HUI chart. I've been using this chart since I started in 2004. This chart.
What's this?
This is what I use.
Oh,
this is the gold bug index. So I call this the chart from hell. We have to go all the way back to 2000 on this one. We went in the chart from hell in 2012, and so you got to go back further.
Is this the Widowmaker in gold or what?
No, this is basically the sentiment. We went in, sentiment died in 2013, and this chart really shows it. But this chart should go back further. You should be able to go back more than.
One of the ones I was talking to you about earlier, Pat, was a Widowmaker SSR.
How far back can you take the HUI? It should go back a lot further than 10 years.
Select start. Let's see. All right. When do you want me to try to?
2000. I don't know. 2002.
Wow.
I don't know how far back this thing's going to go, but.
Wow.
Will it?
If it'll let you.
Okay, try 2010. We're in stock charts. Okay, we got
2010.
That's fine. Okay, so if you draw a line, charting in 2012, 2013 at 150, a straight line.
Yeah, I can't draw a line. But
Okay, that's fine. We can look at the channel from hell, and then 365 is the top. So you can see in 2021 where it went to 365. Yeah, right there. Okay, so we crashed in 2013 and we stayed in that channel. I call it the channel from hell. We broke out of that channel just recently. We just broke out. So we've been in that channel from hell for over 10 years. Now, some people are saying, so I always bought stocks around 200. I always thought 200 was like, that's the place to buy. And anything above 250, you're basically, you're not interested. You're basically waiting because you think it's going up and down, up and down. And so we've been in this channel where it's just basically done nothing for 10 years. Now, we're not, the top on this chart is actually 625 back in 2012. We can't really see it, but we're not even close to the top here, right? No. So we need to get to above 500 for the breakout, and we're at 425. A lot of people think that this is a breakout here, but I think we're going back into the channel from hell one more time. I don't think this is a breakout yet. I think one more correction's coming when the S&P rolls over.
All right.
And then my target for this chart is 1,500. I think we're going to 1,500. These are all large cap stocks, by the way.
Oh, they are. I was looking
What
right
is
now.
Sorry, what does this one represent?
That's what I was
The
about to ask.
H.E.A.T these are large cap gold miners and
Okay.
and some of the large cap silver miners.
So what you're saying is the large cap miners, even though the gold commodity price itself is at all-time highs, basically, the miners are still not hitting new highs.
No, they're not performing. I mean,
Why is that?
it's because Wall Street's not interested. Wall Street is still making money in the stock market.
Right.
So I'm glad you asked this question. This is important.
I ask
So
good questions, man. Trust me.
the reason, so the reason why the miners only do well when you have what I call a fear trade. Now, what is a fear trade? A fear trade is when the average investor doesn't want to be in stocks. So your average retail investor, because your professionals, they always want to, right? But your retail crowd, when stocks are basically doing poorly, they don't want in. They're like, get me out. I don't want any part of the stock market. Do another. Okay, so the miners have only done well in two periods of time. The 1970s, when stock markets languished, and gold outperformed gold. Gold went from $35 to $800 in that decade. Gold was outperforming the stock market, and the stock market wasn't doing well. That's what, okay, so then from 1980 to 2000, gold did nothing. Gold was, a nothing burger. And the reason why is because the stock market was doing well from 1980, 82 to 2000, right? Now, from 2001 until 2011, the stock market did poorly and gold did well. Gold went from 250 to 1900. And if you look at the stock market from 2001 to 2006, the stock market did really, really poorly. And that's when the miners really kicked into gear. Well, that hasn't happened yet. So that's what we need to return. So now, remember, from 1982 to 2000, that's when the stock market did well. Then from 2009 till now, 15 years, the stock market's done well. So the next is going to be the stock market doing poorly, gold doing well, and the miners doing well. So that's what we're waiting for. And that's the reason why these miners haven't done well. Bring up Newmont's chart, and I'll show you what I mean, how Newmont is a real telltale sign. Newmont's trading at a 9 free cash flow multiple, which is ridiculous. If you look at 2022, in 2022, Newmont traded at $80. I think it was intraday, maybe. It showed a high of 77. I had it a little higher. Okay, so its margin back then was nowhere close to its margins today. Right. Newmont should be trading higher than that today. And the reason why it's not is because Wall Street doesn't want to own the miners, because Wall Street, they don't want to own the miners unless they have to. So the way Wall Street works is you go to work and you got to make money to get a bonus. And so if you're a stockbroker on Wall Street, you're going to do what's working because it's working, right? You're not going to switch. But if what you're doing is not making money, it's not working anymore, and you want your bonus, you're going to start looking around for trade. What's working, right? And that's when they buy the miners, when they have no other choice. And so that's
I'm in, man. I'm sold. I like it.
And so right now you got a free cash flow margin of 9.
I know.
You got a free cash flow margin.
I'm calling my broker right now.
Well, my target for Newmont's $300. So you have a margin right now of 9 on Newmont. 9. Well, guess where it's going? It's going to north of 20. So you're going to get 2x. The return is just going to be from the multiple expansion alone, and then you're going to get another 3x from cash flow expansion, going to $5,000 gold. That's the reason why it's going to 300 because of multiple expansion, because it's undervalued today.
And I was concerned earlier when I was talking to Jeremy. I don't know if we're going to have enough to talk about, Jeremy. But anyway, that's not the case. So let's move on then here for a second. So let's talk about like GDXJ versus GDX, gold miner, junior miners.
Well, all right. So GDX versus GDX.
Yes. So I mean, you've talked about.
So there's no reason to own GDX because the risk reward really isn't. You don't get a better risk reward by going to GDX. So GDX is for your large caps, mainly for your large caps, and GDXJ was supposed to be a mid-tier ETF. But guess what? GDX ran into trouble. I don't know when it was, 2015, I think. GDX ran into trouble because they didn't have enough liquidity.
Right.
And basically what they did was they added a bunch of big cap stocks. So GDX is no longer a mid-tier ETF. And so there's really no reason to own GDX.
I should have said maybe with the Elite 8 versus the Mormons. I was just saying, we've talked about the big ones, so let's go to the small ones. Like, let's say we all want to make a ton of money.
Pat, if you know what you're doing, you're going to buy the stocks, not the ETF.
Right.
Yeah, let me finish a little bit about the ETF. So GDX, a lot of people buy GDX because they think it's safer than GDXJ and that it'll pay a little bit higher dividend than the GDXJ, which is true. It does pay a little bit higher dividend. But it doesn't, if you're after dividends, GDX is not what you want to own. No. You want to own the Elite 8 because your dividend's going to get whacked because you have to pay, 0.5% for them to manage the fund. Right. And so if you're after dividends, you want to own the Elite 8 or maybe the Elite 4, depending on your style. But GDX, it's a brand that everybody knows and people buy it and they think that they're buying the best. They think they're buying the Elite 8 basically. But for returns, GDXJ is going to outperform it, and the risk reward I think is about the same.
Right. Well, I was bringing that up as just more of a segue to smaller cap names. So let's say me and Jeremy want to go hit a home run because we don't have like a multi-million-dollar mansion like Matt does.
Right.
So what do we need? Like, give us some names, some small cap ones.
Well, the one good thing about hitting a home run right now, if you're getting it now, is the silver miners are so cheap.
Yeah.
There's 3 silver ETFs. And those 3 ETFs, they not only do they give you a lot of diversification in your portfolio, because if silver prices are going up right now, I mean, the risk reward is pretty strong, I think, in them, because I think we're kind of through this 10-year bear market. So, it's not a bad time. I mean, you're buying these silver miners basically before the breakout. So there's 3 silver ETFs. Well, believe it or not, those silver ETFs, they all have a lot of leverage. I think the silver ETFs are all going to be like 5-baggers. So I just wanted to mention that. So
by silver ETFs, you mean like silver, like SLV and PSLV?
No. The silver miner ETFs. So the first one is SIL.
Yep.
Yeah.
And then there's SILJ. So and then there's other one called SLVR, which just came out.
Yeah, I forgot about that one.
So there's only look at how well that stock's done. 21 to 30 in no time. That's a 50% return in 5 months?
Yeah, that's
my kind of trade.
So there's only 3 though. There's only 3, and these guys just came in. So that's one easy way to get exposure to like 5-baggers. Now we want to go. You want 10+ baggers, right? I have 88 10-baggers in my database right now. 88. I mean, it's unbelievable how many potential 10-baggers there are.
Okay.
Of those 88, I would say, about half of them, 44, are actually pretty darn good plays. But the one thing about trying to find 10-baggers, now Pan American, here's a good example. Pan American, I really like this stock because they just acquired Mag
This
Silver.
is the one I usually trade, and I own it right now.
Okay, so I told you that these silver ETFs are like 5-baggers, right? Pan American is an 8-bagger or better, 8, 9, 10-bagger, depending, because they just acquired Mag Silver, which lowered their silver cost and made them more of a silver name. And now Pan American, it was a really good acquisition for them. So I mean, there's some serious leverage there. Pan American, which is a high quality name, and I have it as an 8, 9-bagger. And if we go to 125 silver, it's going to be a 10+ bagger. So there's your home run right there. But now I gave you all the names in my Elite Eight. So, but I didn't tell you the Mormon list. So
Well,
the
that's what I was trying to get. That's what I was trying to get to. The
the
Mormons.
Pan American is on the Mormon list. So
The
Okay.
carpetbaggers.
The Mormons I created last in February of November of 23. I created the Mormons. My friend of mine, he likes 10 plus baggers, and he swings for the fences, and he buys a lot of dogs. And I
Right.
told him, I said, you keep marrying the ugly stocks. Why don't you marry the pretty girls?
Right.
And I told him, the which ones, right?
Right.
And the pretty girls is Coeur Mining, Hecla, Pan American, First Majestic, Endeavor, Fresnillo, Hochschild, Aya. Those are, I think that's 8. Those are the pretty girls, and I told him to marry those girls.
Those are the pretty Mormons, or those are.
Well,
those
the
are-
reason why they're called the Mormons, he named them the Mormons because I told him to marry all the pretty girls.
So
And so if he's going to marry, Coeur, yeah, CDE, yeah, CDE's done fabulous.
I like CDE.
That's the only one I could catch. You were talking
Yeah.
too fast.
I have CDE ranked number 1, and I'll tell you why.
Yeah.
And so, yeah, and go back even further. I think this stock was all the way down to $2 in last year. It was a screaming buy in February.
Yeah.
$2. So anyway, so he's told his wife he's going to buy the Mormons because I told him to marry the pretty girls. He goes, I'm going to buy the Mormons because he's going to marry
Right.
all 8, right?
Right.
So he named them the Mormons, and I kept the name. And so, and to this day, the Mormon list is still solid as a rock because.
Can you go through it a little bit slower again? I want to get all the girl. I want to get all their names. CDE,
Right, Hecla,
Hecla HL,
Pan American,
PAAS.
Pan American, First Majestic,
I don't know that one. You know the symbol?
AG.
First
AG,
Majestic, right?
AG.
Endeavor EXK,
Endeavor, EXK,
right? Fresnillo FRS,
FRS.
Hochschild HOC,
HOC, that's one.
Aya AYA.
AYA.
That's all 8.
Okay.
And so the thing about the Elite Eight don't have a lot of leverage per se. A few of them do.
Right.
Ken has a lot of leverage. Evolution and Northern Star both do. But the others, I mean, Newmont still does. But these stocks are still super cheap. And so the Mormons, until we get above $40 silver, but what's going to happen here, the people that are listening to this are lucky because they're still early, because once silver goes to $40, all of these stocks are going to double. Boom, they're just going to double. Once you get above $40 and everybody jumps on them, they're going to double because they're all cheap. And when they double, your upside drops by 50%. So they're 10 baggers today on average. And then at $40, $41, $42 silver, they're only going to be 5 baggers. So you're going to lose half of your upside. The people that are late to the game are going to lose half of their upside very quickly. That's how this works. You either get in early and get the big returns, or you wait and you only get half the returns. And if you wait too long, you get a quarter of the returns.
Right. So Don, go ahead, Matt. Sorry.
And the reason why is because this always happens in cycles. The gold doesn't just keep going up to the moon. It goes and it hits a top and it peaks and then it cycles downward. We don't know where the top is. Now, that top for me was 5,000. So I'm saying basically your returns you're only going to get those returns to like $100 silver. But if silver keeps going up 125, 150, 175, then yes, your returns aren't going to be cut in half. So when I say they're going to be cut in half, they're going to be cut in half if we only get to $100 silver.
So let's say the Mormons had kids, and you went to even the smaller
Oh
ones.
yeah,
right?
let's talk about the kids.
Do you have any there's just names on I've looked in your universe, but let's just say I'm like a regular guy and some broker calls me on the blue and has like a penny stock or whatever. How do you decide this makes sense or not? Like you have this one on here, Snowline Gold, SNWGF or Antero. These are all small names, I guess, so how do you know?
The first thing you need to do some homework. You need to read my book. I have a book, the only book that explains how to analyze these stocks. So right there in that, it says free chapter.
SNWGF, man.
It says free chapter, but there's my book. And so
All right.
That book is a textbook, 300 pages long, that basically tells you how to understand the risk of a major, a mid-tier, a developer, or an exploration stock. And so it's going to help you in that regard, because most people will buy exploration stocks at the wrong time. So you mentioned Snowline Gold. Now, Snowline Gold has a market cap of $1 billion, and I think they're an exploration stock. So the way that the Lassonde curve works is the Lassonde curve, when you have that initial discovery, it goes straight up.
SNWGF, Matt.
Right. So the Lassonde curve basically says that you want to buy these stocks when they make a discovery. You don't want to buy them late in the game. And so a lot of people buy these exploration stocks late in the game. Like if you look at this stock, you wanted to sell it at $6 a long time ago.
Right.
Right. You can see it. You can see it. It went to the top, and then this stock is clear as day. People did sell. So at $6, people started getting out, and it went all the way down to $4.69, and now it's back to $6. But anybody that got out at $6, if they got in, this stock actually traded sub $1. A lot of people got in at 50 cents. When the discovery was made, you had an opportunity to get in at 50 cents. So a lot of people got 10 baggers out of this, but this is the Lassonde curve in action. You wanted to get in sub $1 and get out at $5, $6. And people buy this stock still today. To this day, they're still buying it. And so you got to be really careful with that.
So how would someone know, like, when there's a discovery or whatever? I mean, it's a big universe of names out there. That's why they subscribe to goldstockdata.com.
That's why you read my book. That's why you read my book. It's clear as day. I mean, okay, so take this stock back to, take Snowline all the way back to 2020. It's clear as day when they make the discovery. You look at the chart.
Oh, I see.
Go back further. Is that 2020? Maybe that's 2018. Does this thing have an all chart? It doesn't. 10 years. Yeah, do 10. Do 10.
So, I mean, you'd have to be really watching these charts carefully, and you're like, all right, this is breaking out. I like this one. I'm going for it.
Absolutely.
All right.
So those two big white candles there, you can see those. There's two big white candles at the beginning.
See ya.
Okay, so those were news releases. Those were news releases that basically showed what I call an excellent drill hole. So it's something called gram meters. So what you do is you take the grams and you multiply it by the meters. And you want a gram meter hole over 200. And they had, both of those news releases had gram meter holes well over 200. And so the stock is trading, way down there, like 20 cents, 25 cents, sub 50 cents. Okay, then you had, this is monthly, right? So you had those two first months, and then you had four green, these are white, four white in a row in 22. So early 22, you had all that opportunity to get in. So you wanted to get in sub $1. And you you should have been able to get in, sub 75 cents if you were paying attention. That's the beginning. You're at the beginning of the Lassonde curve. You're at the beginning. That's when you get in. It's clear as day. You want to get in at the beginning of the discovery. So so I have two rules. You get in early at the discovery. It has an excellent drill hole. That's number one. Or for an exploration play, the only other time you buy them is when it's what is called an optionality play. Optionality, a good optionality example is Free Gold Ventures. So Free Gold Ventures, they have 30 to 35 million ounces of gold, and they're valued at about $10 in the ground. And so if you can buy gold in the ground for $10, and the key here is they have very strong insiders, and Eric Sprott owns 28, 29% of this company, and another group owns over 20%. They're two private groups, and they need 51% of the shareholders to vote for a buyout. So those two groups basically are not going to sell their stock, sell this company. Free Gold is a pure exploration play, by the way. They're not going to build a mine. So it's basically they're going to wait until somebody offers them $100 an ounce in the ground for the gold. So it's basically, as an investor, it's free money in the long term. This is the most insane thing right now for Wall Street. You can make 300% to 800% on your money by buying the stock and waiting until it gets taken out, because it's a 30 to 40 million ounce deposit that's going to get built. It's inevitable. As long as gold prices don't go down. If gold prices stay where they are now or go higher, this mine will get built. So it's just a matter of when. Somebody is eventually going to buy this mine, and they're not going to pay $10 an ounce in the ground. So optionality plays, the way I look at it, it's free money. All you have to do is wait. You just buy it and wait. Another example is Banyan. They're trading for like $8 an ounce in the ground. If you can buy gold $8-10 in the ground, yeah, Banyan Gold, BYN. If you can buy these stocks for unbelievably cheap, and you basically know it's just a matter of when they get bought. It's just a matter of when.
Do you have to go to Canada to buy these things or what?
Yeah, you want to buy them unless they're trading. This is a good question. You don't want to buy these stocks in the pinks, and if they support OTC QB or QX, that means they give their financials to the SEC.
Right.
And if they do that, then they're good to go. You can buy OTC, but if they're in the pinks, then buy them in Canada. But I think both of these trade QB or QX. Pretty sure.
Right.
So one of my other options income stocks that is a penny stock is NAK, and even that one's getting some notice with metal prices and stuff. So
yeah, so let's talk about NAK. So they have the Pebble mine. So I've always believed that the Pebble mine will get built, but the problem with Northern Dynasty is this like a 4-year build? I mean, this mine is just huge.
Yep.
So they haven't finished their permits yet, and their permits probably going to take at least another year. I do think I'm very confident this mine will get built, but you want to wait for this is a development story. You want to wait until these projects get into production, and it usually takes at least 1 to 2 quarters before they get re-rated. They have to prove that they're going to hit their targets. And a mine at this massive size, it's going to take 2 quarters before after they get into production, before they really prove that they're going to hit their targets. And that's when these companies get re-rated higher. And so you're not basically, if you invest in Northern Dynasty, you're not going to get paid for 6 or 7 years. That's a long wait. That's too far for me. I don't really want to go further than 5 years. I might go 6, but that's why I don't know. That's why I don't own Northern Dynasty. And plus, we don't know the financing on this CapEx. That's the other risk. You don't know how much they're going to dilute you.
right.
So you got double risk. You got the dilution risk, and then you got the long wait for production for the re-rating. So NAC is not one of my. I don't own it. It's not one of my favorite development stories. But for long term, though, investors will make money, but it's a super long wait.
Yeah, I agree. I mean, I've been trading it since 2018, and generally I just sell calls and puts on it and generate income with it. I wouldn't say it would be great for a buy and hold type investor, but for me, it works as an income because my cost basis is well below zero.
Nice.
So I'll just keep selling options on it, but it has picked up quite a bit lately. I mean, it's at $1.40 on the last close here, and it's slowly, sloping up. People are getting a little bit more speculative about it.
This stock could rip to $3 in a month.
Oh, easy. Yeah. I mean, back in just before the flatness that I ended up getting in on in February of 2017. I mean, it spiked up to like $3.45, and then later on it bounced almost $2.50 on July of 2020. So
having a call option on this stock for the next 6 months is probably a pretty good bet. The reason why I say that is because the Trump administration is going to kind of green light this project, I think, in the next 6 months. And one thing it's green lighted, this thing should rip to, $4 or $5.
And that's what the hype was before. I mean, in Trump's first term, I mean, it was essentially just everybody's very gung ho on he's going to, push this and make it happen. And you get all kinds of different environmental groups getting involved and stuff like that. It happens. But for the most part, it's just another part of the permitting process. It just takes time.
Yeah, Trump. Yeah, this is another interesting topic. Trump was not a pro miner his first administration, which is bizarre. But this time he is. He's basically, drill baby drill, open up, the Alaska oil reserves, and then help the miners with all the critical minerals. He's uber pro mining. I mean, he's completely changed his tune on mining this time around, which is very impressive. It's very beneficial for the miners. Perpetua has done really well because of that. They helped Perpetua get their mining permits, and Trump's been in office 6 months, so he's definitely pro mining.
Oh yeah. Drill,
all
baby,
right, well,
drill.
Don, we've extended into record territory here.
I know.
An hour and 6 minutes. Like, I don't know how do we get here? Dude, John, you've ruined it for all the following gold guests. Trust me, it's going to be like moving from a Ferrari to a Toyota for the next one.
I don't think we need any other gold.
Yeah,
guests.
yeah. All right, they're canceled. Yeah, sorry guys. D squared or nobody is what we say at this point.
Well, have me back in a quarter. Have me back in 3 months.
Yeah. Okay,
Definitely.
we will, dude. Very much.
I enjoyed it. I enjoyed it.
You guys should be Don the Dude Durrett. I like that. How about the Dude? Maybe that'd be a good nickname.
my middle initial's D, so that works for me.
Oh, really? D cubed. D cubed even. That's even better than D squared. 3D. 3D. Yeah, 3D. Oh, how did I not see that? All right, we got 3D on. Couple months.
My middle name is David, so.
Oh, really?
There you go.
Yeah.
That's not quite as exciting, but 3D's good.
The one thing I want to say about our website, because
it was Draymond. That might be cool.
Yeah, a lot of people I do have a newsletter, but I'm not a stock picker. I mean, it's not really a newsletter for stock picker. This is more for investors. It's data. It's for people to come in and do their own due diligence. I mean, I do give you lots of names, a list of names, but my newsletter, I don't write up stocks. I mean, most newsletters, they'll write up stocks, and tell you all about it. I don't do that. All I do is give lists, and then I do give a small little analysis of each company. But the point of my database is really for people to come in and do their own analysis. Yeah, click on Abra Silver. But this is free, so it's not going to give you my analysis. When it's free, click on Abra. Go ahead and just click on Abra. So this description, it's a shortened version. That doesn't give you my description.
So if they made a discovery yesterday, would it be on here?
Maybe. So where I would put that is the description. I would put a date. So what I do is if there's significant news. So the description, I only do this. Most of these I only do them once a year, and then I add little dates. So at the bottom of the description, it would have today's date, and it would have the discovery. Yeah.
Right. Okay. Cool.
And then so if you're a member, so what I do is every week, on Wednesdays I have something called Don's Notes. So I collect the notes on a daily basis, and then I publish them every Wednesday. So any significant discovery, but I publish them once a week. But on the forum, if you follow the forum, see, there's a forum there. The forum, they post it daily. So the notes are in the forum daily. So just about anything I post on a Wednesday gets posted every single day. The guys, I have 900 subscribers. And so the forum, I always knew that once I got like over 500 subscribers, that my forum was going to be amazing. And it is. My forum's amazing.
Okay.
When you got 900 people, you can imagine how much news flow gets released.
Right.
So my forum is beautiful. I mean, anything that happens, it just gets downloaded. And so the forum, the forum was really strong with 300 subscribers, but now I'm up to 900. It's become fantastic. The forum alone is worth the $200, but then you get the newsletter and then the database. It's pretty. The value is pretty amazing.
Yeah, it's not stock twits.
Right.
It's impressive. Yeah, I even have Eric Sprott's even a subscriber to my website, which is really cool.
All right.
Nice.
Well,
Hopefully
you're gonna have Pat Neville soon. Trust me. He's a lot better.
Yeah, I'll send this to Eric. He watches a lot of my interviews, so I'll send this to him.
All right, guys.
Hey,
Have a
appreciate
good
it,
one.
guys.
Yeah, we'll have you back 3D any day.
All right.
Yeah.
See ya. Bye.
Outstanding. You guys have a good one.
You
Later.
too. Great seeing you, and thank you for coming on.
Perfect. Bye-bye.
Bye.